So what is an AB trust? You know, a lot of people, they see an AB trust and they go, I don't know what you're talking about. This is nuts. Something really important to understand, laws change. And in 2011, the law changed. It changed in a lot of big ways so that now, and we'll talk about this, now, since 2011, AB trusts are way overused, okay? And they have, for the vast majority of Americans, probably 97% of Americans, 99% of Americans, they have negative overall tax consequences. So some of the good attributes they have can be done in a more tax efficient manner. But something to understand is when you put assets into a B trust, the fundamental problem, apart from having to do a bunch of stuff as a surviving spouse, so we'll talk about a surviving spouse and a deceased spouse a lot, too often creating a B trust results in negative capital gains tax consequences. Now, for those of you who live in California, you must understand that when you have a capital gain, it is taxed at 20% federally, maximum rate. Recapture depreciation is 25%, but there is also a state tax. There's no capital gains tax in California. It's just straight income, and that's up to 13.3% plus 3.8% net investment income tax. That can push your tax bill up to 37.1% for Californians. So it can be a pretty big, pretty hefty tax bill. I'm a partner at Cunningham Legal. I'm Jim Cunningham. I have over 25 years experience. Next year, it'll be 30, but don't tell anyone. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law. I am a real estate broker, securities and insurance license, and a pilot. These are the lawyers in our firm, a great team of lawyers. We're all dedicated to things, estate planning, tax mitigation, real estate. Those all kind of go together in our practice. If you're watching this on YouTube, please subscribe to our channel. You can hit the subscribe button. You can also click the bell and then it alerts you when these are released. And these are kind of, we drop these pretty much every Thursday around 6 p.m. Pacific time, but go ahead and subscribe to YouTube. Disclaimer, I'm a lawyer. I'm talking, words are coming out of my mouth. This is not legal advice. I should probably call this whole like YouTube page, this is not legal advice, but somebody already got that. Not seriously though, don't watch this and then go out and do a bunch of stuff on your own homemade. You really do need a savvy lawyer tip and basically your A team, which is your lawyer, CPA, financial advisor. We'll talk about that. So what is an AB trust? You know, a lot of people, they see an AB trust and they go, I don't know what you're talking about. This is nuts. What is an AB trust? Well, an AB trust is a type of revocable living trust. Now, if you've watched my other videos or heard our podcast, you've got a bucket with a handle, and that bucket is your trust. And into that trust, into that bucket, you put your stocks, your bonds, your mutual funds, your house, your rental property, your stuff, right? You don't put IRAs, 401ks, 403bs, TSAs, life insurance, annuities. Those stay out of the living trust. So we're only talking about assets that are in the living trust, right? That get divided, right? On the death of the first spouse, which is the death of the deceased spouse. And I'll give you a way to remember the B trust, the A trust, and the B trust, which is which. But here's the bottom line. The reason we did this AB trust split is because it saved federal taxes between 1982 and 2011. That's when federal taxes were 55%. They came down a little bit in the 2000s, but it's very high rate. So the purpose of this B trust fundamentally is to save on death taxes on the death of the surviving spouse. So if you have Hal and Wanda, Hal dies, it's to save taxes on the death of Wanda. But bear in mind, there's a price. This is the Faustian bargain, right? The Faustian bargain is to pick up the benefit of eliminating the federal estate tax. You swap that for the potential of capital gains taxes, okay? Now, it's very important to understand we generally can't control the timing of, we can't control the timing of our death. You just die, right? You can control the timing of triggering a capital gain because you only have that when you sell an asset, right? So when you die, you're going to die when you die. Those taxes are due 9 months after your date of death, but you can control when an asset's sold. And our other webinars we've done, we talked about 1031 exchanges and a lot of other tax mitigation strategies. So I would say on the whole, I'd rather pay capital gains taxes than death taxes. But do understand that there is this capital gains tax bill And there's a way to get rid of it, and we'll talk about that. So because the reason is when you have this living trust, this bucket that I talk about, and it divides into two trusts on the death of the first spouse, typically half goes to the survivor and half goes to this other trust that's irrevocable, right? You cannot change it. You cannot amend it. That irrevocable trust, when the surviving spouse dies, the assets in that B trust do not get an adjusted cost basis. Now I'm going to explain something to you. There's a lot of foundational stuff, and then we'll get to some examples. What does that mean? Well, if I buy something for $1 and it goes up to $10 and I die and it's my community property, my wife can sell that thing for $10 and not pay any tax. So she inherits that from me, that $10 item, and then it goes up to 20. And if that's in her estate when she passes away, it's quote taxable in her estate. And I'll get to why that's not such a big deal. If it's taxable in her estate, our kids can sell that for $20 and pay no capital gains tax. So it's called the double step up in basis. So what we're talking about here, this is really, it certainly applies for, frankly, for a lot of Californians. If you're in a separate property state, not so much. And we do talk about that in our other materials. So this living trust splits into two, an A trust and a B trust. So what does A and B mean? The A trust holds the surviving spouse's assets. So if you have Hal and Wanda, they have an estate, they got a $2 million estate, $1 million goes into the A trust for Wanda. The A spouse is the above ground spouse. The A spouse is the alive spouse. So trust A, spouse A is the alive trust, the above ground trust. The B trust holds the deceased spouse's property, and that is the below ground spouse or the buried spouse. So if you're below ground or buried, you're in the B trust, right? Now, this is all Wanda's property because when you die, you don't own anything, you're dead, right? You leave this earth. And so Wanda is the beneficiary of both trusts. So she gets the benefit of both trusts, but they're different terms. So the A trust, typically going to be a revocable trust, meaning she can change it. She can disinherit the kids. The B trust, sometimes Wanda can decide who gets that money when she passes away, but sometimes she cannot. Okay, it just depends on how the trust is written. It depends. Again, a lot of this is kind of, it depends, but I'm just giving you a general idea of what is an AB trust. And, you know, I talk to lawyers that don't practice estate planning. They have no clue what it is, right? If you don't, even lawyers don't know this, right? Oh, there's something I do want to mention. You know, a lawyer, law is a field of, certainly California, law, every lawyer I know is a specialist. No lawyer is a general practitioner anymore. That just doesn't exist. It's too complicated. So 7% of lawyers practice trust and estate law. It's a very small bar, right? Very small number of lawyers do this. And frankly, it's getting harder and harder to find a lawyer. It's, you know, it's why we're doing these webinars, is to help people find a good lawyer. But a lot of lawyers are retiring. So if you're a lawyer watching this and you're yeah, I'm thinking about retiring, you know, you get it. So, so let's talk a little bit more about an A trust. So the surviving spouse, the survivor, so Hal and Wanda. So Wanda is the surviving spouse. She has full control over the A trust assets and can use them any way she wants. She can roll it up in a pipe and smoke it. She can take it to the casino and gamble it away. She can give it to her boyfriend. Who knows? Whatever she wants to do, that's her money. She can do whatever she wants with it. That's going to be trust A. That is going to be the survivor's trust. The surviving spouse can be the trustee of the B trust. Now, remember, this is the buried spouse's half of the money. This is the below ground spouse's half of the money, but they're not always the trustee. It depends how the trust is written. And there are some limitations on access. So she can't just willy-nilly pull it out. Again, if the trust says she can pull it out, they typically don't say that, but she cannot access the money just willy-nilly and take it out and do whatever she wants with it. That's called the B trust, or trust B, the bypass trust, the exemption trust, the credit shelter trust, the disclaimer trust you might see in there. Those are some common names given, but they're all, for our purposes here, they're all a B trust, right? So AB trust is what the lawyers, that's what lawyers call them. The B trust assets are excluded from Wanda's estate, from the surviving spouse's estate. So we have Hal and Wanda. Hal dies. Wanda has her half of the money in the A trust, and Hal's money, his half of the money is in the B trust, like the buried spouse, because Hal's dead, he's below ground, and that money's held for Wanda's benefit. And the money that's in the B trust does not get an adjusted cost basis at death because it is not included in Wanda's estate. It is excluded. And when lawyers will talk about inclusion in the gross estate, meaning your taxable estate for federal estate tax purposes. That sounds bad, but what it does give you is it gives you an adjusted cost basis. So again, Wanda could go out and buy something for $1 and it goes up to $10. If it's in her A trust, no capital gains taxes to the kids if they sell it for $10. But if that same asset is $1 and goes up to $10 in the B trust, the kids are going to be stuck with capital gains taxes of up to 37.1% on the $9 gain. So it's a lot. Those numbers can be really big. And we'll go through an example where the numbers are, they're real. By the way, they're from a real case. And this is a real problem for many, many people, and you'll see why. In 1982, it used to be you could only leave $60,000 without paying death taxes or federal estate tax. Now, then they raised that to $600,000. Well, in 2023 dollars, which is the year we're in right now, that's over $1 million. So, you know, that it would save you $330,000 in tax or $1 million in 2023 dollars. So this was a real significant tax savings. You know, $330,000 back in 1982 was a lot of money, still is a lot of money. And the reason that people started using these AB trusts is there was a strategy to avoid this death tax. And at that time, death tax was up to 55%. But something really important to understand, laws change. And in 2011, the law changed. It changed in a lot of big ways, so that now, and we'll talk about this, now, since 2011, AB trusts are way overused, okay? And they have, for the vast majority of Americans, probably 97% of Americans, 99% of Americans, they have negative overall tax consequences. So some of the good attributes they have can be done in a more tax efficient manner. But something to understand is when you put assets into a B trust, the fundamental problem, apart from having to do a bunch of stuff as a surviving spouse, so we'll talk about a surviving spouse and a deceased spouse a lot. Too often, creating a B trust results in negative capital gains tax consequences. Now, for those of you who live in California, you must understand that when you have a capital gain, it is taxed at 20% federally, maximum rate. Recapture depreciation is 25%, but there is also a state tax. There's no capital gains tax in California. It's just straight income, and that's up to 13.3% plus 3.8% net investment income tax. That can push your tax bill up to 37.1% for Californians. So it can be a pretty big, pretty hefty tax bill. So here's some more information, sort of the 411 on the B trust. You remember you used to dial 411 for information. Anyway, you have to fund and maintain a B trust. So, you know, Hal dies. Hal and Wanda have been married 50, 60, 70 years. Wanda's devastated. She's overwhelmed. It is not uncommon for a widow or widower to just be like, I don't even know what to do. I'm totally overwhelmed. And if this is you, I get it, because I see this with my clients. And I want you to know everyone in our firm gets it, because we work with people like you. If you're watching this and you've lost a spouse, we work with people like you on a daily basis. So if you're Wanda and Hal dies, there's a lot of stuff you have to do. The B trust, this below ground spouse, the buried spouse trust, is irrevocable on the death of the deceased spouse. So the first spouse to die, it becomes irrevocable. And that triggers some rules under the law. So that trust is typically used for the surviving spouse's health, education, maintenance, and support. So Hal's half of the property goes into this B trust. And you can see, if you're listening to this going like, I don't like the sound of that. You mean Wanda just can't access that money freely? No, it has to be for her health, education, maintenance, and support. Gambling's not in there. Now I use a gambling example kind of, you know, jokingly, but the point is, if it's not for health, education, maintenance, or support, she's not getting it, right? So that can be a real problem. So that's a constraint. The trustee is liable for future inheritors of the B trust. So if Wanda, if one of the kids doesn't like how Wanda's managing the trust, one of those kids can take Wanda to court. And it happens, okay? Especially if they're stepkids, right? Or maybe they're your own kids, right? And you guys don't get along, whatever it is, but a kid can actually take Wanda into court while Wanda's alive after Hal's passed away. So that is pretty common. The trustee has to provide a copy of the terms of the B trust to the heirs and future beneficiaries, or provides a notice. And then if they ask for the copy of the trust, then the trust has to be provided. And you have to go through the allocation process, get a taxpayer identification number, and maintain the B trust. This is something called trust administration. We cover this on videos on our YouTube page. And I would really encourage you to take a look at that if someone's passed away and you're not really sure what's going on here, but take a look at that. So there's a lot of stuff you have to do. And then track assets and keep good records. And it's really important. So if you're a kid, and let's say you're one of Hal and Wanda's kids and you have a jerk brother, if Hal passed away and you got a B trust and Wanda's alive, but now Wanda maybe has Alzheimer's, dementia, stroke, Parkinson's, something like that, where Wanda's not mentally able to be trustee and you step in as trustee of that A trust and that B trust, your jerk brother can really make your life miserable because your jerk brother has something called standing, which is the ability to haul you into court and question your handling of the funds. And so we cover this quite a bit in other videos, but one thing is just do yourself a favor. If you're a trustee, do not withdraw cash from an ATM. That is the single worst thing you can do. And again, it's not legal advice. This is information, but you really just probably want to avoid that. So let's say Hal and Wanda, Hal's not dead. He's not the below ground spouse. If you're a Hal and Wanda couple and you go, Jim, I'm listening to this stuff. I don't really like the way this sounds. This just sounds horrible. Then there's something you can do about it. So if you're both alive, right? No one's dead, you can change it. It's a revocable trust. So in our example, Hal and Wanda make a trust in 2003. And it's an AB trust because in 2003, guess what? That's what we did. We did AB trusts all the time. And then Wanda learns that the AB trust isn't so good anymore. So what does Wanda do? She says, Hal, I'm taking you by the elbow. We're going down to Cunningham Legal and we're going to fix this. And what they do is they do a restatement. So they take their prior trust with the same date. And this is a pretty straightforward process. It's legal work. So yes, it does involve legal fees, but they come into the office and we amend the trust. We do a big amendment where we amend all the terms of the trust, bring that trust up to date. It's 20 years old. And now Hal and Wanda have an estate plan that's appropriate for their needs because based on what Hal and Wanda, Wanda watched this webinar or listened to the podcast, and Wanda now says, yeah, this is outdated. I need to fix this. So we can fix that if you're both alive. We'll talk about if Hal's passed away, and that's a slightly different process.